Welcome to the Thematic Investors podcast, presented in partnership with Vidrio Financial. Vidrio Financial is proud to support the Thematic Investors podcast with host Kieran Cavanna. Unlock the potential of precise and dependable investment data with Vidrio Financial's data management solution. We shoulder the responsibility of your data, from its collection to extraction, transformation, and enrichment. With a track record of monitoring over 2,000 diverse funds and processing millions of data points each month, Vidrio leads the discussion on how investors can harness advanced AI and human expertise to maximize alpha performance and enhance their data accuracy. Discover how Vidrio empowers your data with comprehensive analytics on performance, cash flow, risk, and valuation, all delivered seamlessly through Vidrio's data management hub. By consolidating multiple systems into a single source of truth, Vidrio saves your investment teams valuable operational time, providing actionable insights like never before. Explore more at vidrio.com.
Welcome to the Thematic Investors podcast. I'm Kieran Cavanna of Old Farm Partners. Our goal is to bring you great investors with themes they're working on, and some are under the radar, and we think they're all experts in their disciplines. This podcast series is sponsored by Vidrio Financial. It is my pleasure that this episode we have Scott Bessent of Key Square Capital Management, a global macro hedge fund. They're based in Charleston, South Carolina, with offices in London and Greenwich, Connecticut. Scott has an amazing career, which we'll get into in a bit, but on Wall Street mostly, also academia. He's in my view, one of the great macro thinkers in the world. And I had the pleasure working for him when he was at the CIO of Soros Fund Management. Scott, welcome.
Good, Kieran. And I would say we were partners, and it was a fantastic partnership.
That's kind of you to say, but you're definitely my boss. You made that clear sometimes, but I really enjoyed it as well. So thank you. We could take this a number of directions because Scott, I always think of him as a big thinker who has a lot of great ideas. But I think just a little bit, if you don't mind, I know you've done a million things in your career, but I'd love, what brought you to this spot right now where you're sitting and you're trading. I know you're just trading bonds and equities and currencies at the moment. And if you could just give a little bit of background on your career to set the table.
Sure. So I'll just start with my career and not my life background but I think it's important. I'd start when I was in university. So I entered Yale, and I didn't know whether I wanted to be a computer scientist or a journalist. At that time, Yale, being editor of the Yale Daily News, the oldest college daily, was a big deal. And it was a straight ticket to Time Magazine, Washington Post, Boston Globe, most of which are now pamphlets. Junior year in October, I was not elected editor of the Yale Daily News. And so for kind of the next 2 months, I locked myself in my room, went to class, did meals, and came back next semester and decided I better reboot, kind of put on my big boy pants and think what I'm going to do with the rest of my life. And at Yale Career Advisory, there was a notice from Jim Rogers, who many of you may know is George Soros' partner for many years at Quantum Fund, one of the founders, and he had left Quantum, was managing his own money, and he had a notice on the board. Analysts wanted to do spreadsheets, make lunch, clean the toilet, and the key thing was sofa bed available in office. So sofa bed available in office changed my life. I did an internship for Jim, and I thought it was a great combination of the investigative side of journalism. You spend your time on, is an investment worthy of spending time on, as opposed to, is there a story here? Is there a story in the market? Is there a story in the industry? Is there a story at the company? And then you got to think about the world. And then I also got to use my quantitative skills. After that, I went and worked in a bank and investment training program at Brown Brothers Harriman, a very old line firm in New York. And at the time, it was one of the few places that would let you do investment research right out of undergrad. Most other places wanted an MBA. And from there, I went and worked for a Middle Eastern family, which was an incredible experience. They're wonderful family. And a very large investment portfolio, small team, and there were 5 of us. We did the research, traded the portfolio, managed the portfolio, and I did that for 3 years and got to meet a lot of the people who I'd eventually have relationships with, like Byron Wayne, like Lee Cooperman. From there, I went and worked with Jim Chanos, famous short seller. And Jim and I had gotten to know each other. There used to be a lot of analyst breakfasts with companies. Jim and I got to know each other at those. He thought I was asking good questions. So I went and became his first analyst. And as it would happen, Soros Fund Management was our largest client. And part of our deal with SFM was that we would sit in their office and cross-pollinate ideas. And we had a very good run from 1988 until the beginning of 1991. And it was a very interesting time back then. Drexel Burnham went under, there's a savings and loan crisis. Saddam Hussein in the 1990 rolled into Kuwait, so oil prices were up. So there was this great confluence of events for being a short seller. In early 91, I went to Jim and said, I think we've got too many shorts and I don't think we should be short. And he said, well, that's what we do. And I said, well, I think I'd like to do something else. And we continued to have a great relationship to this day. And Stan Druckenmiller, who was the managing partner at Soros Fund Management, asked me to join at SFM. And Stan is my real mentor in the business. And it's humbling being his mentee because, Kieran, as you know, he has never had a down year, since, I can't remember whether it's 78, 80, and it's just some eye-popping returns during that period. And so I joined as an analyst in 91. In November of 91, the management, George and Stan, realized that I'd had a lot of experience with the Middle Eastern family on European stocks. They asked me to go to our London office just for 3 to 6 months. The performance wasn't good there, and just figure out what the fly in the ointment was with the London office. I got there, George couldn't take it anymore and fired the managing director and the whole team. So I was told, don't touch anything. We're going to find a high-powered European fund manager, just monitor the investments. And the portfolio manager had half the assets of the European portfolio in one stock. So I thought it'd be a good idea to research that stock. And the more work I did on it, the more I thought that there were some serious problems. And I started selling the stock, and it was a big position for Quantum Fund. It was probably 10% of the assets of the whole fund. And my selling was pushing down the stock. And George was kind of chewing on Stan. Well, he's not supposed to be doing anything. And great thing about Stan, when it works, is he's from the enough rope school of management. He will give you enough rope to do well, give you enough rope to hang yourself. And so we sell the stock. The stock immediately popped back up. And then a week or 10 days later, they reported earnings. It went down 50%. And George, maybe he should stay.
There you were.
There I was. I decided it'd be a good idea to get an apartment at that point, maybe come back to New York and get the rest of my things. And it was a great time to be in Europe. The wall had come down, and then famously in September of 92, UK left the ERM, the European Exchange Rate Mechanism, and Soros Fund had a very large position. We had a very good day that day, called White Wednesday. I stayed at SFM, managed the European portfolio until full-time until 97. 97, I started managing more of a global portfolio. And if I backtrack for a minute, in 92, after the pound devaluation, this gets back to Stan's enough rope theory. I was in New York and I went in the office and I said, there are these in Europe, there were 17 or 22 different currencies, and the stocks in Finland go up and down based on what the mark is doing or based on what the Dutch guilder is doing, and it'd be helpful to be able to trade currencies. So Stan said, "Do you want to trade currencies?" And I said, "Yeah." And he said, "Well, why don't you go ahead and trade bonds and commodities while you're at it?" Like, great. And that's really when I started trading macro. And Kieran, I don't know whether you want to talk about it here or now in terms of the style and the Soros and Duquesne micro to macro.
Sure, that'd be great. Yeah.
So the Soros and the Duquesne / Druckenmiller style of macro is very different than some of the more pure macro shops, or they are relying on macro data. My current view, and even our view back then, and George, Stan, myself, had all started first doing stocks, and we understood companies. We talked to a lot of corporate management, and our view was we didn't really have an edge in predicting non-farm payrolls. But if you were talking to a broad swath of companies and they were telling you that they were hiring, the economy's good, then you didn't have to try to predict payrolls. You didn't have to try to figure out what the inflation number, the PCE, is to a couple of tenths. If the companies are telling you that they're getting 5, 7, 8% the price increases and passing it on to the consumer. So that's a lot of the basis for that model. And it's a lot of the basis for what my team and I continue to do today.
That's great. It's a good segue. I'd hate to give short shrift to the last 25 years of your career. I will tell you when you were CIO at Soros, when I was there, you're very successful. You had a great run, and a lot of that due to Japan, I felt, right? Both up and down, right? That's fair. And, I wouldn't mind if we could go back to some of your career. I mean, you've definitely had some really great high points. I'd love to get into sort of today, if you don't mind. Because I mean, it's quite an interesting time, right? Excessive debt, lots of things going. I'm just tell me what you guys are thinking and how are you trading these days? What sort of themes are appealing to you?
Yeah, so for what we do is either policy mistakes by government officials, central banks, corporates are very important, or divergences. So in general, for my style of macro is when everything is going well, when vol is low, when the consensus is always correct, that's less interesting for us. Except maybe vol is low and we can create some asymmetric payoffs if we have a big disagreement. Why don't we go around the world? And since you mentioned Japan, we'll start there. So I've been going to Japan since 1990. So I got there right before the peak of the bubble. And for those of you who weren't around in the 80s, Japan was taking over the world. And at one point, the Imperial Palace in Tokyo was valued more than the entire state of California. There was a fear that there's a Japanese management method, there's a Japanese, and like with so many things, there was the Japanese manufacturing sector was and still is incredible, and the Japanese financial sector was a disaster. So you had this manufacturing juggernaut that would then put it into financial assets, and the bubble blew up, and the Nikkei peaked end of 1991. And then fast forward, it really took until 2012 for it to start to recover. And it was one of the biggest bubbles in history, or asset bubbles in history. And it was 20 years to work off the hangover. And so fast forward to 2012, I had been thinking about Japan, obviously coming back for a long time. What was the catalyst? And one of our consultants said, "Oh, there's this fellow named Shinzo Abe, and he used to be prime minister. His grandfather was prime minister. He's going to come back, and he wants to bring Japan out of deflation, and you should come see him." And I was convinced that he was serious. I didn't know if he could do it, but I also knew that there was a very good appointment calendar for the Bank of Japan. He was going to get to appoint the chairman. He was going to get to appoint a lot of board members. So he melded the Bank of Japan with the government, and Abenomics was born. There was a massive easing, a big devaluation of the yen, and the equity market took off. And so that was the monetary and fiscal part. The real part was the corporate governance change. And that's what we're seeing today in Japan. And yeah, I think that Japan is probably the only stock market in the world that is in a secular bull market. And by that, I mean that it could go, we're back to the old highs. And I think there's no reason we couldn't be 50, 60,000 by the end of the decade. And this corporate governance change is real. I remember going to Japan the first time and being sort of a brash young analyst and having corporate CEO say, Mr. Bessent, you're a shareholder. And we have 4 other constituents who come ahead of you. We have our employees, we have our banks, we have our customers, we have our communities. Oh, and then there's the shareholders. And now there's a real emphasis on shareholders, shareholder value. And I think that's going to continue.
Before we go around the world further, I mean, I do think one of the more appealing things to me about the style of investing that you engage in is that it's sort of a mix of liberal arts, math, Excel, synthesizing a lot of primary data, right? I saw you did a speech recently talking to young people saying, get out there, talk to people, learn everything you can, but only you can synthesize it. Do you think that really is still valuable in a day and age with data's everywhere? And
yeah, look, I think 2 things. I like the Dostoevsky quote, know something about everything and everything about something. So like, that's what we try to do. And more, Kieran, as you correctly point out, everyone has the same data. It's how do you interpret it? Because for us, the most important thing for us is framing. And everyone it's kind of like the Sigmund Freud test, is what do you see? So do you see glass half empty? Do you see the glass half full? Do you see like this is high risk? Do you see this is low risk? Very, very good example of that would be is I remember going into the presidential election in 2016, I didn't think Donald Trump was necessarily going to win, but I put a much higher probability that he could win. And it was very cheap to create options that he could win.
right.
Then the night when I think John King on CNN was about to start crying and he said, Hillary Clinton has no path to the presidency, the market immediately crashed. And the futures locked down in the middle of the night. And I just had a very different view. I thought, like, this is going to be the most pro-business president for many years that we've seen in many years. And it would be shockingly bullish for the stock market. So that was a long answer to your question, but you have the data. How do you process it? And how do you turn that into a trade?
Yeah. I mean, I've just started to bring in my own view, but I think in macro land, we've talked about the birth rate in Japan being such a huge headwind for so long, and that has not played out whatsoever, right? Yet, or it might, but who knows?
Well, it hasn't played out whatsoever, but what everyone's missing is that per capita GDP keeps going up.
Yeah.
So the other thing too is, I think I said it the other night at the Citadel, there is a chance that Japan first and foremost, but globally, the industrialized countries get bailed out by AI.
And robotics.
And robotics, because if you think, okay, what is GDP? It's population growth, working population growth, plus productivity. If you're having a decline in working age population or engaged working population, but you have this incredible productivity fill up, like Japan may actually have the last laugh.
Right. I would love to shift since we're going around the world, because I think China is such a huge focus. Could we talk about China? And I mean, it's quite a run the last 5 years, and I'd love to hear what you think now.
I think that there was a chance China could have worked. And I think Xi Jinping has made the decision that he knows more than the market. There was an interesting symbiotic relationship between the state and the free enterprise system from, say, 2000, 2002 to 2012. There's this capitalism with Chinese characteristics. And I was never sure it was going to work, but there's a possibility it could work. And in 2013, when Xi Jinping came in, I became very concerned about his telos or ethos, and that we would end up in a much more autocratic place, and we have. The other thing, too, is because China is such a big country, such a big economy, so populous, so populated, that we tend to think that the rules of gravity and economics don't apply to China. And that's just wrong. Is like the debt profile, the amount of debt, the unproductive debt, it's all coming home to roost now. I think it just took longer because they had a lot of unfair trade practices. They kept a very big current account surplus, and you can do a lot of silly things when you have a big current account surplus. And they've just run up this gigantic unproductive debt. And I think we will see in the next year or two whether the Chinese economy, as we believe it exists, actually exists.
Wow. Well, yeah, we certainly are mired in it's going to be interesting to see if the breakdown occurs with the factory floor of the world. But we'll see.
Well, but the other thing too, and this is, you mentioned earlier that I'm quasi-academic. I've studied the history of economics and financial markets, and it's always interesting to see how things are marketed or the dominant perception. So
yep.
From say 2002 to 2012 to 2015, all the Asia funds became Asia ex-Japan.
Yep.
Asia was booming, Asia was growing. A lot of the Northern Asia countries were doing very well. Obviously, India was doing well, and Japan couldn't get out of their own way. Now we are starting to see indices being formed Asia ex-China, and Japan is back in, and China's on the outs. And these things tend to run for a while.
Could we shift to the US on this? Because you said something about unproductive debt, and I know you've been concerned with the US debt, and it's a big year for elections, obviously, and you've been pretty politically active in the last year. So I'd love to get your thinking on the debt. I mean, the stock of the US debt is enormous. Our current account deficit's enormous and going to stay this way for a while. So what do we do?
Well, we need to at least signal that we're going to be serious about getting it under control. The number I would throw out is 100 days. Every 100 days, the US adds $1 trillion of new debt. Just in February, the US debt financing cost went over $1 trillion per year, just in interest payments. Put it in perspective, the defense budget is about $970 billion. So now we're now spending more on interest cost than our entire yearly defense budget. And because of what's happened with our debt profile, Secretary Yellen is financing at the front end of the curve. And as a result, every 100 days, we add $150 billion to the deficit, just mechanically. That's not with more spending. That's not with worse the income tax collection. That's just mechanical from the old cheaper debt rolling off and the new 5% debt appearing. So yeah, we've got to do something, because at a point there will be a problem, and it's always very difficult predicting where it is. And Rogoff and Reinhardt's seminal work that came out around the great financial crisis called It's Different This Time. They looked at debt crises, and in a huge portion of the crises, there were no indicators 6 months before the crisis happened. So the US is the reserve currency of the world. And I think that it's having the reserve currency is called the exorbitant privilege. And I think we have abused the exorbitant privilege.
I saw you in a speech talk about how this is it's an issue fiscally and monetarily, but it's actually turning into a national security issue.
Sure. When the debt service is higher than your defense budget, and then when you think the second largest foreign owner of your debt is probably, if you get into a kinetic conflict, probably one of the two countries you get into the kinetic conflict with, China or Iran, China is the second largest holder of the debt. So that is not a good equilibrium.
No, right. I've seen some really great speculative investors like Stan talk about publicly that we should have termed our debt out a long time ago. Is that do you hold that view too?
Completely. It is. And it's not 2020 hindsight. The American households termed out their debt. What we're seeing now is monetary policy is not affecting our monetary policy is affecting the housing market in a perverse way now, because so many Americans went out and got 3.5%, 4% mortgages during the COVID years when rates were low. And now their mortgage is an asset and they can't move. So you're ending up with this kind of inverted logic where high rates are constricting supply. And then additionally, corporate America turned out its debt. The largest borrower and the most aggressive borrower, US government, is the only, when you think of household, corporates, and government, it was only the US government that didn't term out the debt. And over the past year, we've actually shortened the profile, which strikes me as very fiscally irresponsible.
At a time when some other countries had 100-year bonds, right? I mean, we looked at one, Switzerland, right?
Yeah, well, Austria. Yeah, but I think Mexico has a 50-year bond. Corporates, Disney has a 50 or 100-year bond. I bet the US is going to be here more than I bet the Magic Kingdom is going to be here in 100 years.
As a quick another aside, if you don't mind, because I know you teach a class, or you taught a class at Yale on a mix of finance and history. And I'd love to just quickly hear what sort of things you looked at in the past, and then look through what the big themes are today, which are somewhat geopolitical, we talked about, but maybe AI, which I know you've said in the past just recently is one of the biggest things happened in your career.
When you think, could AI be the equivalent of the Industrial Revolution in terms of a tech revolution? Is the late 1880, 1890, up until 1900, the US had this incredible disinflationary growth boom and huge amount of productivity. We also had population growth. So, perhaps AI could be like that. Studying history is fun because I had an encounter with Sam Bankman-Fried about 9-10 months before FTX went under. And he and I got into a heated discussion, and I ended it with, well, I'm sorry, buddy, you look like a US bank in 1907 when there was a bank run before the Federal Reserve existed. And I think one day you're going to need a lender of last resort and not have it. So it's good to be able to frame something in.
I guess that equates as a zinger from a guy from Yale, I guess.
It is when you're talking to a guy from MIT, yes.
Yeah, okay.
He had a few more F-bombs in there for me.
But how could this play out from your perspective on macro?
Well, I think it's too soon to know that there could be a big productivity boom. Is it initially inflationary? Because one of the things we tend to have like some, what I call meta macro thoughts, and like too much debt is one of them, but then you can take some of the themes down to a more granular level. And one of those would be okay, that we're probably going to see, I don't know, $1 trillion of spending by the hyperscalers, who would be OpenAI, Microsoft, Amazon, Google, Oracle, and the Musk companies, and on data centers. And data centers use a huge amount of electricity. And we're probably working ourselves into an electricity shortage, maybe by this time next year. In a world where the average citizen is being told you're naughty for eating meat because your cows contributing to global warming, maybe these data centers are going to be bigger contributors, but no one's going to tell them not to do it.
Right.
But you could end up, it was a long way of saying it could be inflationary before it's deflationary.
Yeah. Right.
You've got to build the physical assets, and that is now competing with U.S. industrial policy on chips and green energy. And now you add this data center component, and electricity prices are going to go up, construction costs are going up. So it could be deflationary at first and then deflationary. It's what, one of my mentors, and I think Kieran, you knew him, was a great Morgan Stanley strategist, Barton Biggs. And one of his most famous essays was called Fire Then Ice. My general view is maybe we could have fire then ice.
Right. I mean, you saw that along the lines of what you're saying. I mean, Amazon just bought a huge data center in Pennsylvania next to a nuclear power plant, and they're paid pretty high premium of current power prices for 10 years. That may turn out to be a good deal.
I think it's going to be a great deal. I think it's going to be, it's going to be a great deal for Amazon. I don't know what kind of deal it's going to be for the people who live in that neighborhood.
Right. Fair enough. I mean, I would love to shift back. And what about Europe too? Do you have any strong thoughts on Europe you want to go through? Because I could rip through a whole bunch of other questions on other geographies if you like.
Yeah, nothing too strong in Europe. I think Europe is kind of the good, the bad, and the ugly. The good companies are always well priced. I've seen like an index of family-owned companies that has probably outpaced some of the Magnificent Seven here in the US on a 10 or 15-year view. There's some fantastic companies, and the managements are used to doing business in kind of adverse regulatory environments. One of the things I would say is I would expect that no matter who wins in November, that the Ukraine-Russia conflict will be over, or we will be approaching a settlement, which I think is probably very good for the risk premium in Europe. So I think for a long time, people were saying Europe's uninvestable. It's this, it's that. And I would expect too that we would see 500 billion or 750 billion of rebuild funds going into Ukraine. I would also think a large portion of that would be toward resiliency for the easternmost NATO countries. So I wouldn't be surprised if you don't see some kind of a mini boomlet in Europe over the next 12 months.
Yeah, it's rearming everything, right? Well, there are a lot of things.
Yes.
I would love to walk through macro investing too. It's kind of gotten I feel like a 10-year, a bit of a headwind, and the S&P has just been a rocket. So why do you need to diversify? And I think sometimes, one of the reasons we engage in macro investing is you can get such asymmetry. If you're right, you can get such a big return. I was just looking at a guy that we like quite a bit mutually. Discovery Capital's having a great run here in the last 18 months after 5 years of a tough run. What do you think? What do you think about macro now on a go forward, and maybe why it hasn't thrived in the last 10?
There were things to do, but they were mostly up beta trades for a long time. You could have gotten Japan right. Some macro funds did invest in tech and did very well. When you and I were at SFM, we did. But in general, the best times for macro are not when there's a lot of equanimity in markets. And if the central banks are kind of able to do a smoothing function, which they have been, or which they were able to, then there's not much volatility. There are not many surprises. I would say that one of the things that macro people are good at, we have good imaginations. We've seen a lot. We're looking at what markets give us in terms of asymmetry. We're looking at options markets. We're looking at futures curves, and that when things don't go as planned, or when there's surprises, when there are jolts, then that's when we tend to do better.
Yeah, I mean, a quick aside on the imagination front, I found it fascinating when I learned a bit about your background and other macro investors. They really do have a strong liberal arts background. Honestly, some of the best guys out there, and historically, Caxton, Tudor, and others. Imagine can't trade. Yeah, I mean, you got to be able to do the math, but boy, you can't trade imagination in this space.
Yeah, like Stan Druckenmiller is an English and an econ major.
God bless.
George Soros, I think, was a philosophy.
Yeah. Like, thank God he wasn't a great philosopher, or else he wouldn't have been a great risk taker. Could you talk about the U.S. election coming up from a investing standpoint? I know you've been very active politically, but just from because you've talked about the debt, and there are many things going on in the U.S., but it does feel like the stakes are extremely high in this election. And could you talk about that a little bit?
I can talk about it from a financial point of view, and if you'd like, from a political point of view. But from a financial point of view, I think if we step back and frame it, since 1952, you've never had a down year when an incumbent is running for president. Why is that? Because thus far, his political apparatus and economic apparatus is pumping in a lot of fiscal spending, a lot of liquidity into, via the banking system, via the Fed, into markets, and they're quite buoyant. So I would expect that we would see the same thing this year, and indeed, Jerome Powell has been very surprisingly accommodative, and Janet Yellen has been brutally political and turning the dials and the knobs as quickly as she can to try to influence the election. And my guess is that the more we see Donald Trump ahead in the polls, the more she will be doing that. And then on the other side, in general, I think markets are more drawn to the Trump's policies. So Trump tax cuts expire in 2025. I would expect that if he wins, they will be extended or made permanent. We would see much lighter touch regulation and a little less of the off-the-wall regulatory edicts that we see issued, just generally more market friendly. I think we'd see lower energy costs and much more drilling in America. And my differentiated view is that I think we would also see President Trump try to tackle the debt, which is very at odds with the market view that he would be a prolific spender.
Sounds like there's some politics in there, but would you add anything on your own politics side?
Yeah, look, I think there's a decision now, and Lael Brainerd, former vice chair of the Fed, the only senior member of the Fed ever to make a political donation, which he made to Hillary Clinton in 2016, is now in the right place. She runs Joe Biden's economic team in the West Wing. She is chair of the National Economic Council, and she delivered a speech at the Economic Club of New York last summer where she said, look, we're going to keep spending. We're going to let most of the Trump tax cuts expire, and we are going to raise taxes in 2025. And that is one way to do it. That is a different view, and that is a view that I'm not sure the stock market will love. I think that there is still the opportunity if an administration, preferably Republican, were to freeze spending. You don't have to cut spending, you need to freeze it. I think if we do that, then interest rates would start coming down and the market would start being attracted by this idea that deficits, maybe the deficit could be cut in half over 4 years. But that, Kieran, that was a long way of saying that no matter who wins in November 2025 is going to be a mess.
Right.
There's a debt ceiling in January. So I can't remember. It seems like it's January 25th. Inauguration's on the 20th. So there's going to be a lot of toing and froing going into that. And I'm also open to the idea that just as the market sold off and then recovered when Trump won in 2016, that maybe it just gets very ahead of itself going into the election, and maybe there's some kind of crescendo on election night, and the lame duck session for 2 months is very choppy.
Well, I shifted back to risk taking, if you don't mind, just for a minute, because you've assembled a really great team of people I've gotten to know over the years. But you're not a big screen person yourself, right? I don't think you have a Bloomberg on your desk.
Yeah, I have Bloomberg.com, which I think is $40 a month, and you have to activate it. It doesn't tick all the time. For me, for some people, there's information value in watching prices go from green to red to yellow during the day. And for me, I find it's just a distraction. And that goes back to what I told the cadets and the audience at the Citadel the other day. You just really got to find what you're good at. And there's some people who can sit and trade every day. Paul Jones, Stan Druckenmiller are incredible at that. There are other people, I'll put myself in this, who kind of have a view, we're going on a trip from A to B, and I just need to manage the volatility in between, and I can't add very much value in my trading. I can add value in my structuring.
Yeah.
Is if I can structure things to keep me in the trade.
Yeah, I think it took me a couple of years to understand. I think you said something like, let's remember that the main thing is the main thing.
Yeah, like that's from basketball coaching legend Pat Riley. Keep the main thing the main thing. And if I think the Nikkei is going to go from 40,000 to 60,000, there are going to be some squiggles in between. The same thing. If I think there's a chance that we could, at a point, go parabolic in gold, then a little less worried about small pullbacks.
Well, last thing I want to end on was that, one thing I've noticed is you've been doing this for quite a while. You've seen a lot of different interesting markets, but you seem to really enjoy it. You really do. You seem to have a passion for it. You like it. It's the intellectual pursuit. I mean, is that the kind of thing that drives good firms, do you think?
Yes, it is. I think I mentioned to you before, my sister always tells me she's jealous because what I love doing pays a lot. And I'm very fortunate in that. But I was just talking to someone at a big firm who had just joined a few years ago. And he said, what's interesting here is no one has any hobbies. They're just interested in the work. And look, I think it's great to have hobbies, and I have hobbies, but when I'm interviewing, I think that the greatest employees I've ever had are the ones who dream about the game. Do you wake up in the middle of the night, and Kieran, I know you do because I've gotten emails from you early in the morning, late at night, on weekends, and it's, this jumble's been going around in my head, and it just clicked and locked and loaded, and this is the answer. And you really have to have that commitment that it's a grueling business. Stan Druckenmiller was great because is great because he would always say, when you're at your peak, watch out, you're probably cruising for bruising. And then when you were down, he's like, smart people don't get stupid overnight. I still got a lot of confidence in you.
Yeah.
So you really have to enjoy it. If you're in it for the money, then there are a lot of other things you can make money.
Although, and it's interesting, I think you've hired some good people over the years. I've noticed that, what's changed a bit, right, is you love to find these younger people who are quantitative, smart, hungry, but maybe didn't go to the best reputation school, but they have just as much ability, right? I mean, you seem to have
Yeah, it is. I think it's ability and it's hard work. There's no level of entitlement. And I don't think I mentioned this to you, but one of my former students at Yale became an analyst and now works at an asset allocator firm, shared with me that I did a presentation for them and she shared the introductory memo. And I thought it was one of the greatest compliments I'd ever seen, because she said, I'd just been in China with Scott. We got on the plane to come back from Hong Kong, and I knew he was very smart, but I looked over and he was typing up all his notes, and I realized I could never outwork him.
Amen to that. That's great. Well, Scott, I'm gonna leave it there. I think that you provided some really interesting insights right there, and it's going to be a great 12 months, I bet, for macro. So, good luck here.
Thanks. There's always luck too.
Yes. All right. Thanks, Scott.
Thank you for supporting the Thematic Investors podcast, presented in partnership with Vidrio Financial. Vidrio's data management solution collects, scrubs, and allows investment teams to filter out the data noise, providing you with actionable data intelligence for further visualization around valuation, risk, and portfolio management. If you are an endowment, foundation, pension, sovereign wealth fund, asset manager, OCIO, or family office struggling with your data pipelines, then reach out today and see how Vidrio's data management solution can help by becoming an extension of your investment team. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Vidrio Financial and/or our host, Kieran Cavanna. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding investment planning.